What is going on, investors? Hopefully you guys are doing well out there. It is time for Fintech Sunday here on the Investor Channel, where we'll take a look at 4 different fintech stocks, all down over 40%, some of them down over 50%, some of them down over 60% from their 52-week highs. We'll take a look at a little bit of the news that gotten us to this point. We'll take a look at the fundamentals, and you're definitely going to want to hang around for the technical analysis segment of each of these stocks, because conventional wisdom says when you're down this big over the last 52 weeks, well, look, it might have pulled into a buying range. Well, we'll answer that question when we look at this from a technical perspective and a fundamental perspective as well. Reminder that I'll have timestamps down below to each of these 4 segments. So if you want to jump around to the stocks that you're interested in, you're more than welcome to do that. We will talk about Block, otherwise known as Square, on today's show. This stock reports earnings on March 3rd. This stock is down 59% off of its 52-week high. We'll talk about PayPal as well. This company reports earnings on February 1st. This stock is down 47% from its 52-week high. We'll talk about SOFI, which just made news of their long-awaited bank charter. This company reports earnings on March 3rd. This stock is down 52% from its 52-week high. And then finally, we'll talk about Affirm. This company is reporting earnings on February 11th, and this stock is bringing up the rear, down 67% from its 52-week high. Now, fintech investors must wait, and this will be a critical 2 words on today's video. Fintech investors must wait for market to gain conviction amid sector rotation. So when you see stocks down this big, okay, down at minimum 47% and maximum 67%, you have to wait, because we have a sector rotation, we've had profit taking, and on top of that, we've had major technical levels just continuing to broken down the chain. And as stocks go up, they can be irrational. And as they can go down, they can be as irrational as when they go up. And so we have to wait until signs of a reversal. We'll talk about that quite a bit when we get to the technical segment. Now, let's kick things off with Block, otherwise known as Square. Ticker symbol is still SQ. I don't think they have any interest in changing that. Over the last year, stock's been hammered, down 46%. The market cap on this one is $54 billion. We still have a forward PE of this one at 70. So despite being down 46% over the last year, the stock still has a PE of 70. That should tell you, again, our key phrases will be must wait, sector rotation, and signs of a reversal. Those will be the key things that we talk about on today's show. Now, Block pushes ahead with a plan to build a Bitcoin mining system. They claim that this is going to be a decentralized and permissionless Bitcoin mining system, as much as it can be, I guess, owned by a public company that interest is in profits. And so we'll see how that works out. But I tell you what, Block is probably the one stock out of all that are scatterbrained, might not be the best word, but they're a little bit all over the place, okay? They've got a little bit of payment processing. They've got the Cash App, which I think is absolutely fantastic, and they've done a nice job monetizing that. They've got a huge amount of Bitcoin revenues. We'll talk about that here in a second, how that relates to their valuation, and we'll talk about all these things. Now, Block is set January 31st to close its Afterpay deal after getting Bank of Spain's okay. It looks like this deal is likely going to be able to get the okay from all the regulators. Block is going to be able to tie in this large buy now, pay later stock, but unfortunately, they probably overpaid. If they would have waited for their stock to pull back along with the rest of the stocks in this market, well, they probably could have gotten this Afterpay stock for an even better price. That's all, that's more or less an opinion, but my guess is the valuation of that stock would have gotten washed out with the rest of these, and they probably could have gotten it at a better price. That also could be weighing on Block's share price as well, as investors digest the fact that they probably overpaid for Afterpay. Now, in terms of fundamentals, let's take a look at the annual EPS. So this is earnings per share estimates. They're coming in this year at about $1.68. That is, again, still giving us this forward PE at about 70. Now, in terms of next year, it looks like you're only, and I say only, it looks like that's only going to improve by about 20 cents per share. Stock's anticipating to go to about $1.86 per share. Now, the high end of the range is actually $1 higher than that at $2.86, but then you you have some analysts thinking they're going to fall flat on their face next year and actually cut that in half to 92 cents. And so we'll see where Block falls in that EPS range. But this is not really explosive growth on that earnings side from a PE perspective, because at today's current price, if you grew that 20 cents per share earnings, well, you would only reduce your PE by about 7 to about 63 times forward. That would still be an epically high valuation for this stock, at least when it comes to earnings. Now, the other way we can analyze Block is, look, this company might not be, really focused on profits, and we'll give them the benefit of the doubt for that. But take a look at this, our annual revenue estimates, okay? This year that we're in now, they're expected to do about $17.63 billion. The high end of that range is up to about $18.7 billion. Well, next year, it doesn't look like we're going to grow much at all. In fact, only about $900 million, according to analysts. This company is expected to get to about $18.57 billion on that revenue side. The high end is, I don't want to say just, but it's just up to $21 billion in terms of revenue. That would give us a price to sales ratio at the current time. So our price to sales ratio is about 3 times. Next year, again, about 3 times, because we're not seeing a lot of growth here on this revenue side. Now, one thing that we have to understand about Block's financials is this company derives a fair amount of their revenue actually from Bitcoin revenue. So this is people trading Bitcoin on their platform. In the most recent quarter that I have here, they had $1.8 billion worth of Bitcoin revenue, and they had $3.8 billion of total revenue. Okay, but what we have to understand about Bitcoin is off of that $1.8 billion worth of revenue, they had $1.77 billion worth of cost. They're basically just serving as a middleman for that transaction, and it's a low margin business. Look, they're making money off of it. It's a way to retain customers, get customers that might come on there and trade Bitcoin, and then they do other services that make Block more money. So I'm not saying that they shouldn't do this or this is not a worthy business. We just have to understand from a price to sales basis, which we'll look at here in a second, well, it's skewed just a little bit by the fact that their sales, or their otherwise known as revenue, is a little bit elevated due to this very, very low margin business. So I just want you to understand that when we look at this from a price to sales basis, because I do have the price to sales chart here of Block. This is a 5-year chart. We're sitting at about 3 times sales. Next year, if you all things being equal, including the share price and the number of shares outstanding, well, they're still going to be trading at this 2 to 3 times. Well, look, from a traditional valuation metric, if you want to analyze Block from a price to sales basis, this is about as good as it gets. Okay, over the last 5 years, this is actually where we've seen the stock bottom out at about 3 times sales, and then it's gone on a rally. It's been down here at 3 times sales. This was even before it had a lot of that Bitcoin revenue, and it's rallied hard. So if you want to rely on price to sales, well, I tell you what, it's a screaming buy right now when it comes to Block from that valuation metric. Now, let's look at this from a technical perspective as well. Now, Square or Block was in this long sideways consolidation. In fact, it lasted from October of 2020 until about December of this year. So it was actually in this sideways consolidation for over a year. The bottom end of the range was down here at 194. The top end of the range was probably a little higher than this, up here at about $280 per share. And it just chopped in that range. Now, when you see stocks doing this, we see Google doing this, we've seen Amazon do this, we've seen Apple, we've seen a lot of stocks doing it. That's why we keep such a close eye on the bottom of the range. And that's why I changed this line to red, because when you break through it, this line turns from support to now resistance. And this stock solidly broke through it, okay? And that should have been your signal to get out of this stock. Now, you wouldn't necessarily have to set your stop loss at the bottom of a consolidation zone, but maybe $10, $15 lower than that, because once you solidly break lower than that, look, we've gone from 194 all the way down to 118 on this one. Hello, that is an absolute disaster. So you might say, well, look, it has to be over. This stock has to be done going down. Well, unfortunately, I have bad news for you from a technical perspective. This stock, sure, it can find some footing here and start a reversal. We'll talk about what a reversal in this stock will look like here in a second. But from a technical perspective, this stock doesn't have any significant support until there's a small, I'm talking about a very small area here at $100, and that probably is more psychological than it is technical. But the stock, I would say, would find some footing at $100 per share. I wouldn't necessarily be super excited about jumping in there, and I certainly wouldn't until you get down all the way down here to the notice we have a previous area of sideways consolidation with Square. Okay, the stock actually sideways consolidated for over a year between $59 and up to about $85, and then it broke out. Okay, and so that is our area where we would first actually even think about stepping in on this one, and that's all the way down at about $85 per share. The bottom end of the range, like I talked about, is closer to $60 per share now. So you might be really worried. You might have shares already and you're thinking, wow, we could go from 118 down to 85. Absolutely. When we looked at the traditional valuation perspective, from a price to sales perspective, it's a buy, but from a price to earnings basis, this stock is still way overvalued. And so that could be what's weighing on investors as the stock continues to go down. Okay. Now, the other thing that we think about is we could stop. Okay. The stock could stop here and find some footing. What would that look like? And we can take a cue from other times this stock has done reversals. Okay. This stock went from 84 back down here to like 37. What did it do though? It created higher lows. Okay. It created some lows here, some higher lows, and then it finally got actually over the previous area of support at 58. That would have been your signal, I think, to buy, because you would have taken out the previous lows, previous highs. And look, you didn't get it at the bottom, but you went from 58 all the way up to 280 on that one. That would have been one of the greatest trades anybody has ever done in their lifetime, okay? And so the same thing we're waiting on now with Block, okay? We're waiting to make higher lows on this one. We're waiting to take out the previous lows, which are right now at 140. I'll remind you, the stock's at 118. I wouldn't even think about buying the dip on this one unless we got over 140, because you notice all along this downtrend, okay, we go down, we pop up, then we go down, we pop up, we go down, we pop up, we go down, we pop up, go down, pop up, go down, pop up, but we're never popping up above the previous set of lows. Notice we never get above it. It's always below it. So right now, where the stock is right now, to show that it maybe is reversing, this stock has to put up a green candle above 140 for it to signal that we've reversed. Otherwise, the downtrend is 100% intact. That is what it's saying from a technical perspective. That's what people are typing into algorithms, to computers. That's what traders at the biggest trading firms are looking at. This stock is in a downtrend. It is showing no sign. I'm telling you, absolutely zero sign that this stock is going to stop, okay? I would actually anticipate this stock continuing to go down at least until about $100 per share. It would shock me, in fact, if it doesn't come all the way back into likely this previous area of sideways consolidation. That means this monster leg that you made after the March lows of 2020 is probably, I think, at least from a technical perspective, likely going to be given away. Now, again, it could be wrong. Technical analysis is not right 100% of the time, and maybe not even right a large percentage of a time. But in order for you to be a successful buy the dip investor, you have to be patient and you have to wait until we get above the previous lows, which are right now at 140. If the stock continues to go down, well, I tell you what, this line continues to kind of march its way down. Okay, we keep going down next week. We make even lower lows. Well, you can keep pushing this down, but I will remind you, the stock has to bounce and get back above those highs in order for you to want to step in and buy this one. Okay, so that was Block. It looks terrible, absolutely terrible from a technical analysis perspective. It looks a little bit better from a price to sales basis, but from a price to earnings basis and revenue growth and earnings growth doesn't match up. You would expect a company with a 60 to 70 times forward PE to be growing their earnings far faster and greater than this company is, and they simply are not. Next stock we'll take a look at in the payment space is PayPal. This stock over the last year is down 34%. We got a big old $192 billion market cap on this one. The PE on this one is a little bit more reasonable at 35 times. We'll look at this from a news perspective and a fundamental and technical perspective as we move through this. PayPal explores a stablecoin launch to further its crypto aspirations. So like Square or Block, this company is also relatively deep into crypto. You can buy crypto on your PayPal account, although I would say that Block's integration and their aggressiveness in the crypto space is a little bit more ahead of PayPal. But what they're looking for is with a stable coin. Basically, what I think a stable coin is it's basically, they define it here as a digital assets that meant to be pegged to a fiat currency like a dollar. I just look at it as just another name for a dollar. If it's pegged to a fiat currency, it's basically just a different name for that currency, but it could avoid some of the payment processing and some of the fees that associate trading something like a fiat dollar. We'll see if PayPal's able to do that. Obviously, they have to get that through regulators as well. PayPal stock is headed for its biggest annual decline after its Pinterest deal fizzled. So obviously, as you recall, there was a rumor out there. I don't know if it was floated by Pinterest. I don't know if it was floated by PayPal. I don't even think we know the validity of this deal, but it was floated out there that PayPal wanted to buy Pinterest, which would have been an interesting thing because it would have put them from a payments company to, as we know with Pinterest, they make the vast majority or all their income from essentially online advertising. They probably have some commission deals in there as well. There's some Pinterest shops and things like that. But for the most part, that company makes money by online advertising. So it would have put PayPal in a business that it doesn't necessarily have a lot of expertise in. I think it would have been an interesting tie-up, but it would have bloated PayPal's balance sheet since they do not have the cash on hand to complete a deal like that. They would have had to either issue a ton of new shares or they had a mix of debt and new shares in order to complete that deal. I think all things being considered for both companies, probably better that it didn't go through, especially at the timing of that deal. PayPal shares were really high and Pinterest shares were even higher. They would have paid a massive premium for a stock. Pinterest stock, like these stocks as well, have been just come crashing down over the past month or so. Now, in terms of the annual EPS from a fundamental perspective, PayPal is expected to do $4.61 per share in earnings. That gives us a forward PE of about that 35. Now, they're expected to grow their earnings by about $1.20 next year. All things being considered, if the stock price were to stay the same, that would give you a forward PE on this one at 30, which again is elevated. For some investors might seem overvalued, but from a stock that's growing its earnings by $1.20 over a year, that's not probably wildly overvalued from a forward PE basis. And I'll show it to you here on from a graph perspective as well. Now, from a revenue perspective, we're going to go from about $25 billion up to about $30 billion. And it appears those are going to be pretty tight. Okay, you got 45 analysts projecting that, and they're projecting between 29 and 33 billion. And so to come in the midpoint of that at about 30 billion, maybe even 31 billion, that's pretty solid revenue growth. And from a price to sales basis, you're going to go from about 7.5 times to about 6.3. Again, that's all things being equal, including the share price today for PayPal. Now, what does that look like in the context of PayPal? Right now, like I talked about, this is a price to sales chart. We're trading at about 7-8 times sales. Notice that's right here, okay? Also notice that that is where PayPal traded for several years. In fact, once it got to about 8 times sales, it would kind of get bounced down to about 6 times sales. It traded between 6 and 8 times sales for like 2 or 3 years, and then it just got blown up, okay? And it just shows you this sector probably got out in front of its skis a little bit. And look, I think just retail investors bid these stocks up too much. Well, you probably benefited if you held this stock, and now you're kind of, you're getting the short end of the stick, but it can create, as retail investors get flushed out of these, it can create some buying opportunities. From a price to sales basis, PayPal's actually looking like a decent buy. Now, from a price to earnings basis, again, we're trading in that kind of high 30s, almost 40 times on that forward PE basis. Well, look, this stock is traded as high as 100 times. That was clearly wildly overvalued, but again, paints the same story as the price to sales. Between 2018 and 2020, this stock actually comfortably traded between about 40 and 60 times sales, and we're actually at the bottom end of that. In fact, when this stock last bounced, it bounced at this price to earnings ratio at about 40. So from that basis, PayPal is actually looking like a buy from a fundamental basis. Now, from a technical perspective, paints a slightly different story. Now, I was in this stock. I did buy it on this sideways consolidation because, as you notice on our graphs here, we had a nice sideways chop with PayPal, okay, between about 181 and about 213. And we actually blew up above that and we chopped around up here. Once we broke through 230 on some earnings call, I remember doing this video, the stock actually went up when we were doing the video. And then after the video, the stock just took an absolute dump. And so it gapped down after earnings, and then it gapped all the way down here to the bottom end of a very, very clear technical range, down to about 181. And I bought this stock somewhere in here at about 189 or so, but I set a stop loss right below this, right at about $179 per share, because we are in a downtrend on this one, okay? But it did look like, at least in the shorter term with PayPal, we were chopping sideways. I actually thought this one was, actually going to survive. This is the importance of stop losses, okay? Because technical analysis can tell us one thing, but it can be wrong. And in this case, it simply was wrong. And this stock continued to head lower. Notice that once we broke through this level at 179, we went all the way down to 163. So I took a small loss on this one. If I had held it, I'd be down even more. I'd be down 10, 15% on this one. You just simply cannot do that on these speculative stocks. Also, these stocks, in my opinion, also overvalued. Now, from a technical perspective, you might say, well, what does that mean? Well, what does that mean? Now 180 is a resistance level, and it should be a pretty hard resistance level because it was area of support, and now we've broken through that. So your upside back from 164 is back up to 180. That's not a lot of upside, okay? And so that's why I wouldn't necessarily think this is a buy the dip opportunity. You might ask yourself, well, where's the buy the dip opportunity? You see these green lines down here, and I know they're a long ways down, but these are your next buying opportunities, and still until you see a sign of reversal. We'll talk about that here in a second. Your next buying opportunity is down here at the previous highs that we made. Notice the stock went sideways between about 2019 and 2020 down here to about $123. That is $40 lower than where the stock is right now. And so some of you are saying you can't possibly be predicting that PayPal stock goes down another $40. That's what the technicals are telling us, that this stock could very easily drop from 163 down to here to 123. Look, there was not a lot of people that probably predicted we'd go from 312 down to 163. There's probably even less thinking we'll go down here to 120, but that's what the stock is telling you. I would not get excited about the stock on a downtrend until you got down here to about 123. And again, I was fooled back here when I thought we could stop here. And look, a lot of it wasn't just me. Okay, notice this stock hung out in this 180 range for a while because a lot of people were looking at the exact same thing I was, that this was a hard level of support here. It made sense that the stock would find technical support here, but it didn't. And so I would not get excited about buying the dip in the shorter term until we got solidly above 185 on this one. You got to get back above this previous area of support, which is now resistance. Until you get above it, it is not a buy. I would stay far away from PayPal until you get above 185. As you pull down lower, you've got a nice, beautiful little gap right here. Notice this gap between 139 down to 124. That is why I'm saying this stock, if it keeps going down, it really only needs to get to about 139. You get to 139, it's almost guaranteed to drop another 20 bucks because you've got no price action right here. This stock will just slice through that like a hot knife through butter. So I would not touch this stock until you started making higher lows on this one. In the shorter term, that is a move back above 185. Okay, then I would think about maybe, but then think about your upside. Your upside from 185 is back up here probably to 212, and at the most back up here to 227. So you got about $40 in upside. I wouldn't mind this. If I bought it here at 185, again, I would put a stop loss back down here at about 180, 179, probably to be more exact, okay? So if you buy these dips on these ones, make sure you're putting the stop loss back at the previous area of resistance, which would then be support. Again, you've got to get above that for that to happen. My prediction on this one is we are headed lower and we are going back down, in my opinion, probably back down to the 120s and 130s on PayPal. Next stock we'll take a look at is SOFI Technologies. This company over the last year is down 37%. We've got $11 billion market cap on this one. Now, fundamentally, this stock has really changed its story. So initially, it was more in the basket of a PayPal, of a Block, of somewhat Affirm. Affirm is a little bit different than these companies because they're strictly a buy now, pay later company. But SOFI is really interesting in the fact that they are now a bank, okay? So they received regulatory approval to become a national bank. They purchased this Golden Pacific Bank Corp, and they basically bought this bank, which only had 3 branches in the United States, but they have a charter to be a national bank. So they can, essentially what that means is this company can take deposits and then loan that out. It also gives them access to kind of Federal Reserve rates. They can borrow money and get money at better rates. They can also offer those rates to their customers at competitive rates as well. We can't do it yet, but in probably the next 6 to 12 months, we'll be able to actually analyze SOFI from a traditional banking metrics, okay? We'll be able to look at them from a fee perspective. So companies like Wells Fargo and Bank of America collect fees and those types of things on credit cards and other services they have, but they also generate a large amount of their income simply by taking in deposits and then lending that money out for cars, for homes, for business loans, and any kind of lending out there. SOFI is going to turn more into a traditional bank. That means you're going to be able to analyze this a little bit more from a traditional banking metrics that would take it into the price to tangible book value. So the price to tangible book is essentially if you were to liquidate all of SOFI's assets, like the company had to kind of sell itself, that would be the value of the assets on the bank. Right now, you can't do that because they're not quite there yet from that perspective, but we'll get there. Now, the other thing that we have to remember about SOFI is this company is not profitable. They're expected to do negative 95 cents per share in earnings. Obviously, you can't really do a forward PE in that sense. The forward PE is negative, which basically means it's infinity, but they are expected next year to go to negative 55 cents. So they're moving in the right direction. The way we can analyze this a little bit from a traditional valuation metric is just look at this growth rate. So this year they're expected to do about $1 billion in revenue. I'm assuming these estimates, you've only got 12 analysts making these estimates. I'm assuming though, for the upcoming year, these analysts have factored in a little bit of growth due to this national charter. This has been baked into the company to a certain degree, although we've seen the stock price off quite a bit with SOFI, but it's been baked in that this company will get this charter and will likely have revenues coming in the door from that segment of the business here pretty soon. Well, they're expected to grow their revenues by like 50%, up to about $1.47 billion. And again, keep in mind, this is a company with $11 billion valuation. And so you're growing your revenues by 50%. Well, you're going to grow into that. You're going to grow into that valuation pretty quickly. You got a price to sales basis of about 7 on this one. Now what I want to do is take a look at SOFI from a technical perspective. This one actually paints a little bit different story than the rest, in the fact that we have found some footing right where the stock is right now, right at about $13.75 per share. The other thing that we're doing though is we're creating somewhat of a series of lower highs, although this one was a little bit higher. So we'll see what this means. This stock hasn't been public for long. It's changing it. I wouldn't say it's changing its business model, but it's going to change its product mix here in the coming months and years ahead as it turns itself more into a traditional bank in terms of its lending. Right now, it's at $13.80. If you want to take a flyer on this one, you like it. It wouldn't, from a technical perspective, it's not the worst thing, because I think what could happen, and again, it's happened 3 times now, or at least 2 times, is we've gone up here to about over $20 per share, and we've crashed down here to 13, and then we bounced up here to 20, crashed down, bounced up here, and now here we are again. So technically, we could easily bounce back up here, and so I think you could easily play that trade from about 13 up to 20 if you want to, but I would caution you, set a stop loss on this one because like I opened with, there is a sector rotation here. People are risk off on these types of things. People do not want. I would put a stop loss here somewhere in this $12 to $13 range. You would not want to get this stock below that range because then I think you're coming back to these lows really since the stock kind of IPO'd back down here at about $10 per share. That's what I see from a technical perspective from SoFi. Last stock that we'll take a look at today on our FinTech show is Affirm. This stock over the last year is down 47%. We've got about a $16 billion market cap on this one. Now, this company has done a nice job partnering with different companies. We've seen them partner with Amazon. We've seen them partner with a number of different companies. I've used Affirm for numerous purchases. When you get no interest for 6 months, you might as well use it. I tell you what, and it's fantastic from a consumer perspective. They've just partnered with Newegg, which is, I think, a computer software or a technology shopping app, and that is a nice tie-up. Now, Affirm stock dipped 9%. This was back in December as regulators opened up an inquiry about buy now, pay later credit. So what regulators want to understand is, how is this affecting consumers? How are they collecting the information? I don't necessarily think we're going to see the regulators put a kibosh or put, hard limits on these types of things, but they're just wondering how this consumer credit option is moving through the system. Now, Afterpay, which is being acquired by Block, is to start a buy now, pay later subscription service, and Affirm shares drop. Look, we've got a lot of innovation in this space. You've got companies like Block and PayPal that are all in this space, and so we'll see a lot of innovation, and I actually think it'll be great for the consumer. I think it's actually going to drive down prices or cost of this debt, and in some cases, like I said, every time I've borrowed from Affirm, it's been at 0%. And look, there's got to be some kind of cost. They got to be using my data or something like that. But look, at 0%, I'm not paying physical dollars out of my pocket. It seems like a good deal. I think we'll continue to see innovation in this space. Now, Affirm's holding, this is really negative to shareholders. This was back in November, but they boosted their note offering size by $250 million to $1.5 billion. Obviously, if you're going to be extending credit, so you have partners like Amazon, you have partners like Newegg, you have all these partners coming on board, and you have consumers using these services. Well, all of a sudden, you need way more money, okay? Because what does Affirm have to do? They actually have to fork over the money for the product, and then they get paid back later by the consumer, and there's obviously default risk and those types of things. The other thing that I don't have an article up here about, but Affirm is tied to Peloton. So if you buy a Peloton, you don't want to pay for the whole thing at once, and when we're talking about $2,000, $3,000, $5,000 bikes and treadmills, well, it actually is a pretty good option. Well, look, Affirm business is tied to Peloton, and we've seen over the last few months and weeks especially, Peloton has just taken an absolute dump as it appears demand for their products is drying up. But again, Affirm is tying up other retailers out there, and it should help this business stabilize to a certain degree. Now, what we do see is from an earnings standpoint, this company is expected to do negative earnings of $1.35. This is why it's such a good deal for consumers, because this company is actually losing money by offering you this credit. Next year, they're not expected to be profitable at a negative 83 cents per share. Now, from a revenue perspective, we're going from $1.28 billion. That's not $1.28. That's $1.28 billion. We're expected to grow that to about $1.8 billion on Affirm. I talked about how this company has a $16 billion multiple on it. So you have to keep that in mind when you've got just $1.8 billion in revenue coming for the upcoming year. Well, that's not great from a traditional perspective. Now, from a price to sales, since we can't analyze this from a price to earnings basis, this company's not profitable. Over the last year, we see this thing ballooned over to 30, nearly 40 times sales, and it has just continued to come back. We do see there is some appetite for this at about that 10 times sales. And so if this company right now is trading about 12 times sales, if it can pull back, continue to pull back, you should see some appetite, although I'm only on a one-year chart because Affirm just recently went public. Now, from a technical segment of Affirm, this stock hasn't been public long, so we don't have a lot of data, but we do notice that this stock did sideways consolidate for a little bit between about 50. You can even drop this down to here to about $50 per share, up to about $70 per share. We're kind of in the middle of that box at about $57 per share. Now, we are on a we're talking about a mega ski slope downtrend. So I would absolutely absolutely not want to step into this one until you start making some higher lows. In the shorter term, we're talking over the next, really the next month, you'd have to get above the previous area of support, which is now, should be resistance actually. So this line actually turns red because this is resistance now. You got to get above this line right here at about $69 per share. Again, you're at 57 on this one. I would not, absolutely not want to touch this one in the shorter term until you got to about $70 per share. That would take out this level of resistance and then turn it back into support. So if I bought this one on the breakout above here, I would set my stop loss somewhere underneath that at about $68 per share and try to let this one run, because look, once you get above 68, you've got this big gap right here. I mean, this stock could easily run back into the 80s before it saw any level of resistance. So I like this one back above 68. I would not, absolutely not touch Affirm stock until you got back above this, okay? There's just not a lot of upside. And you might say, well, what if it pulls back down here to 50? Would you buy it down here? Not really, because I think your upside is back up to this area of support. So yeah, you go from 50 back up to 66, but what risk are you taking? You're taking risk that this stock breaks below this level too, okay? Or that we just chop down here, okay? So I wouldn't be excited about this one, even on a dip buy back to the previous area of support down here. I wouldn't be excited. This is one of those rare cases, and newer investors don't typically understand this technical analysis, that I actually would be more excited buying this at 70 than I would down here at 50. Okay, and that doesn't make a lot of sense. And when I was a new investor and new into investing, that didn't make sense. It would make sense, oh, buy it at 50 rather than 70. No, because your upside from 50 is back up and hitting your head somewhere up here, probably actually lower, probably back up to 64. So your upside isn't that great. I would play the breakout above, and it depends on where you want to draw this line. There's a spot here at 65, but probably the more firm level and the more, really confirmed level is above 70. You get above 70 on this one and you've got high upside in this one. First of all, you will have reversed a trend. You will have turned an area of resistance into support. Those things really line up well from a technical perspective, but either way, I would set a stop loss if I was to play this breakout above the previous area of support at about $69 per share. That wraps up today's show. Hopefully you guys enjoyed this one. Leave me a comment down below with any questions. Hopefully you guys have a great day. Good luck with your investments.